In L&T Finance, we've been actually one of the pioneers in sort of building AI-based underwriting engine. It's an engine which we call Cyclops, right? We operationalized in the month of June. The name Cyclops comes from the fact that it's a one-eyed mythical giant, nothing misses it. And the fact is that, for example, for our two-wheeler business, we use 16 algorithms right now. Wow. Actually 18. It's gone up by 2 more. It's 18 algorithms which humanly is not possible.
Not possible.
So these technologies are very, very liberating technologies from an underwriting perspective. It makes the underwriting science much, much more stronger.
Yeah.
But on the other hand, managing these models and addressing the model risk is also equally important.
Yeah. Hello everyone and welcome to this special series on Paisa Vaisa, Credit Conversations with TransUnion CIBIL. Through the last 3 episodes, we've gathered a fair understanding of the credit landscape and the role a credit bureau like TransUnion CIBIL plays in the lending process of almost every person in India. Today we are joined by Mr. Sudipta Roy, Managing Director and CEO L&T Finance, and Mr. Bhavesh Jain, Managing Director and CEO of TransUnion CIBIL, to delve further into the world of credit. Now, adding to the mix, today we are going to discuss the impact of technology on the credit environment, including the role of AI and blockchain. Welcome, gentlemen. It's great to have 2 representatives of the credit industry, one representing the lenders aspect, Mr. Sudipta, and one representing the credit bureau ecosystem, Mr. Bhavesh. So, Sudipta, let's start with you. Lenders play the role of decision makers in the lending process, and L&T Finance is one of the major players in the lending industry. Could you elaborate on the role L&T plays in the credit system?
See, I think we've been, as a lender, have been around for more than 30 years now. And we're an upper layer non-banking financial services company. Our asset size is almost close to 1 lakh crores. And we are one of those sort of very unique non-banking financial services companies that have equal presence in the urban sector as well as in the rural sector. Most of our other competitors are primarily focused on the urban sector or solely like NBFC MFIs, solely on the rural sector, but we straddle both. 50-50 is our AUM split between urban and rural. So in the rural sector, we are one of the largest players in the microfinance industry. We're the 3rd largest player and actually the largest NBFC player in the microfinance industry. So obviously you understand that microfinance actually enables a lot of women, especially in the sort of the rural areas of India, to get on with their entrepreneurial journey. So we play a large part in facilitating that. We are the largest tractor lender in the country, and again, the farmers, the equipments that we give to the farmers, especially on tractors and farm equipments, go a long way in assisting the agricultural production of the country. On the urban side, we are one of the very large lenders in two-wheelers. So two-wheeler mobility is something that we bring to the customers. Home loans, loan against property, personal loans, SME business loans, to a certain extent, microloan against property, warehouse receipt financing. These are varying lines of products that we have. In fact, we straddle a lot of the products. But, the way we understand both the rural consumer and the way we understand the urban consumer, I think there are very few lenders in the country who do equally well, right? So I guess that is what is the sort of value add we bring to the credit industry of straddling both the segments with equal ease.
Okay. Bhavesh, coming to you. So credit has been evolving rapidly with the adoption of digital solutions and credit scoring models. Can you elaborate on how adoption of digital solutions and credit scoring models are changing the credit landscape?
Thanks, Anupam. Valid question, because today digital solutions and credit scoring has changed the way lending happens in this country. When we go 20 years back, TransUnion CIBIL has been in India and being the leading credit bureau we complete our 25th year this year. So if we go back more than 20 years back, access to credit were available through physical branches of credit institutions. That has changed today. No more an Indian needs to go to a branch of a bank or an NBFC to get access to credit. They can do it at the comfort of their home or their business premises or a mobile phone. Now that's a big, massive change. And what it has enabled is that it has enabled to get consumers from the semi-urban and rural locations. And more so important is the Gen Zs, who are mobile first population. they are very comfortable to do financial transactions on mobile. So, through the advent of digital solutions, it has brought a large section of the society from semi urban locations, from rural locations, across all age groups.
Sure.
Now, that has really brought great inclusion, if I may say, and great inclusion has enabled consumers getting access to credit at their choice, at their terms and condition, at their convenience. And that has sort of created so much of opportunity for the consumer and businesses alike. And to your second question around credit score, similarly, credit score has ensured that a consumer, irrespective of their age, their social strata, their financial backgrounds, they are evaluated objectively. So, if a consumer has a CIBIL score of X, they get evaluated basis their credit history, because they are given credit basis their performance in the past. All other parameters don't take precedence. It's actually the credit performance and the credit score which gets the maximum priority for a consumer to get access to credit. So that these two things have actually changed the credit ecosystem in the country and has really propelled growth for India in last 2 decades.
Yeah, so the two logical questions that come from here is financial inclusion and financial future, right? So on financial inclusion and technology, the way things are going now, I feel that pretty much every Indian, or at least people who have smartphones, can enter the financial ecosystem using technology. So financial inclusion and technology as an area of focus going forward, how do you think that's going to shape out?
So it has already changed in a big way. Today, a farmer can get a Kisan credit card. A student who's just out of college and getting into a corporate world or a factory or employment can get a loan to buy their first smartphone or feature phone. An individual looking to commute and buy a two-wheeler can get a loan. A student who's looking for an education loan can get a loan along with their parents from any of the banks or NBFCs. So today, a consumer or a citizen in this country can get access for different uses, for studies, for commute, for communication, for farming. They can get access to all the credit solutions in the country. And that has been achieved because of multiple reasons, technology being the biggest factor. Because technology has actually disrupted and enabled access to credit, because you don't need to put up a physical branch anywhere in India. The consumer doesn't have to wait. If you go 30-40 years back, a consumer had to wait for a few hours in a bank branch to get access to a credit application. Today, all those things have changed. Today, the Gen Z, no more thing that going to a branch of a bank is part of the plan during the weekdays or weekend. It's no more in the itinerary. When I sort of speak to my father or grandfather, it's actually visiting a bank branch was part of their plan from Monday to Saturday.
Yeah.
That's how things happened 20-30 years back. That's no more the case. So technology has actually taken credit to every Indian household, and today access to credit is available at the comfort of a living room, on a sofa set, on a mobile phone. That's how financial inclusion has been enabled, and that's the beauty about technology, that it ensures safety and convenience at the same time.
Yeah, so now let's get one step further. Now that a person has entered into the financial ecosystem, as far as credit is concerned, credit self-monitoring tools are very important, okay, to ensure that there is good behavior on credit. Could you share your thoughts on how these tools, credit self-monitoring tools, help individuals take control of their financial futures?
Absolutely. So monitoring your credit is very similar to monitoring your health, because you need to know your key parameters, how your body is reacting, and what type of preventive actions you need to take. This is very similar. So any change in the credit activity of a borrower's report, you need to monitor it real time. Now, how does one do that? Any citizen in this country can come onto CIBIL.com, can download the CIBIL mobile app, take one annual free credit report along with their score, monitor their credit report, can subscribe to real-time alerts, so that if they have any change in the credit activity on their report, they get alerted, they proactively monitor it. Now, why that is important is that the moment you monitor it, you can action and take the right steps to ensure that you are maintaining a good credit history and a good CIBIL score, because your ability to negotiate or get the best terms and conditions within the country is basis your good repayment history.
Yeah. What Bhavesh said works really well. It helps me as a consumer who's looking out for a loan to approach a lender like you. Okay. Other than what Bhavesh has said, what other aspects should I as a consumer or a borrower, not lender, sorry, or borrower should focus on?
See, I think it's to maintain a good bureau score, right? Especially a CIBIL score is very, very important for you to be always be of sort of an approved sort of set of customers who can tap into credit at any point in time. However, it's very important for you to maintain a bureau score above a particular level because many organizations have varying cutoffs, right? And a couple of things, I call it a hygiene discipline things. First and foremost things, if you're dealing with financial services, financial products, especially products which you have borrowed, right? You have to treat that borrowing behavior or the repayment behavior with extreme discipline. We have to make sure that at least, you pay the dues on time. Most of the sort of static asset products, I call it static asset products because, there's a fixed EMI every month, etc. and all that stuff, right? Those get automatically done and probably, debited from your bank account. So it's very important to maintain your sufficient amount of balance in the bank account so that, when the debit comes, it does not get bounced. These are very simple hygiene things. But for dynamic products, for example, credit cards, etc., right, where you spend and your outstanding might depend on amount of you spend and your minimum dues might depend on how much you have spent. It's very important to keep track of the repayment dates, payment due dates, and make the payments because if you miss, then it goes as a negative because it will be reported by the lender to the bureau, and subsequently your score might go down a couple of points here and there. One of the mistakes many people make is that when they have a dispute, they stop paying. It is natural that, during the course of your process, some customers might have some disputes, some mistakes might have been made by either the lender or the customer. The mistake can be on either side, right? And when you get into a dispute, a lot of customers said, okay, fine, this is a dispute, I will not pay. Now, what we advise as lenders is that is the wrong thing to do. Keep on paying, right? And then dispute. Because it is important for you to demonstrate that your dispute does not sort of impinge on your credit behavior. Because if you don't pay, your buckets will move, you'll become delinquent, and unfortunately most systems are computer driven. It's very difficult to go back and erase. When it gets reported, it will get reported as that. Please understand that lenders don't have any control on that. The system does it automatically, right? So if you have a dispute, please pay and then dispute and come to a resolution. And last but not the least, for example, as part of the monitoring of the bureau score, if you see an anomaly somewhere, please take it up the bureau, and the bureau gives you the details of all the lenders. Now, for example, I'll tell you what happened with me.
Okay.
Right? And this is long back, not now, so Bhavesh can breathe easy, right? About 6-7 years back, suddenly I realized that on the bureau, I have two tracks. There are maybe there was some particular key issue or something like that. I had two reports on the bureau. One report is a much longer report and the other report is a much smaller report,
sure,
right? Sure. And, somehow one lender landed up on the smaller report and then said that whatever you're saying is we don't have those records. I don't know what was that issue. So then, those two records were merged at that point and one unified record. Maybe, Bhavesh can throw some light on that, right? But when you find an anomaly, you have to highlight it to the bureau as well as to the lender.
Sure.
Saying that this is an anomaly and this is something, which I don't agree with, right? And please correct it. And then provide the backings to correct it. And the bureau has process and systems to correct that as well. So I think, overall, if the customer is vigilant about, the bureau score is what I call a financial, your financial HbA1c, right? In the sense that, above a particular level, you are kosher, below a particular level, you are not kosher, right? You will find difficult to get credit facilities. And each and every customer should make their efforts to sort of make the bureau score always in the green. In US, people swear by, what they call the FICO score equivalent in US, right? Because in US they know that having that score above a particular level is tapped to the credit tap. Here also CIBIL score is like generic these days. People know about the CIBIL score, and having a good CIBIL score is important for credit facility in the market.
Yeah. So, what happens now is that once I know my credit profile and I know which lender to approach, that's my job is done.
Yeah.
Once I walk into your door, right, or for that matter any lender, how important is it for the lender to make me understand their offerings and in a way that I can understand, and how does L&T do this?
Offerings in terms of the product offerings?
Yes.
Yeah.
See, because I have understood my profile in terms of credit and I have understood the lender. So two things are matched.
Yeah.
Now, how do you explain to me what is ideal for me in terms of your offerings?
Yeah, so obviously disclosure is very, very important, and one of the important things that we always see is that, the customer should get the right size loan, right? The customer should not overborrow. The customer should not, get lesser than what he or she probably wants, right? And I think the key to this is something which is internal to the organization and something which is external to the customer.
Sure.
Now, typically, if you see, and we follow a little bit of a rule of thumb, saying that, what is the maximum amount that you can get, right, will depend on your income or your gross monthly income or your net monthly income, whatever it is. Each and every organization has a different metric. It is very important for the lender to explain to the customer, saying that, look, your income is so much, right? Your need is so much, right? Your repayment capacity according to, and what we do as lenders is calculate two things. We calculate the aggregate debt burden, and we calculate if it's unsecured loan, we also calculate the unsecured debt burden. The fact is that the risk weights on secured assets are lower, the risk weights on unsecured assets are higher, right? So typically your unsecured debt burden will be lower than your secured debt burden. Rule of thumb, most lenders, look at about a 60%, secured plus unsecured debt burden, because you have to leave some money out for the customer to live, for his daily expenses, for etc., right? You cannot leverage the customer beyond a particular point. So what we try to do is try to tell the customer through a little bit of a rule of thumb, saying that if your income is so much, you will get so much. Now, I will be very honest. Most lenders do not go into too much of nitty-gritty styles to explain, saying that your unsecured debt burden is so much, your secured debt burden is so much. We don't go that.
Sure.
But rule of thumb is that, for example, if you have a credit card, you will typically get a credit line which is 3 or 4 times your monthly income, right? Unless you have a huge track record, 20 years track record. Typically, if you go for a personal loan, you will get something between 8 to 10 months of your monthly income as personal loan. And, a home loan kicker will be much, much higher, right? So typically people are told about, not everyone, but, the most experienced sort of salespeople, they tell their customers about some of these rule of thumbs. But the fact is that what we try to tell the customer is that if you have a good bureau score, if you have a good repayment history, if you have a reasonable income, and if the loan that you are taking, whatever it might be a mortgage, it might be a loan against property, it might be an application for a credit card, it might be a personal loan, depending upon your income, you have to cut your coat according to that particular cloth. And the duty of the lender is to advise us to what is the exact amount of loan that you will get.
Yeah. Now, moving to the more important part of technology like artificial intelligence, machine learning, that's also going to have an impact on financial literacy, financial inclusion. But moving to the specific process of the credit decision making, how will AI ML allow for more accurate risk assessment and credit worthiness evaluation?
I think that's a brilliant question, and the fact is that is a question that I often get asked in most forums these days. And See, what happens is that credit underwriting, and typically till this time, right, has been done, at at a broad parameter level, right? In the sense that, you look at a customer, you get the customer's bureau score, you sort of try to fit the customer within a box. If the customer does not fit within the box, or depending upon within the box the customer fits, you try to underwrite. What artificial intelligence or machine learning does is to widen the box.
Yep.
Right, because there might be customers or the nuances of, say, for example, a couple of things we look at while underwriting. We look at the bureau score.
Yep.
We look at the customer's liabilities track.
Yep.
If he has a bank account, we look at the customer's bank account. We look at where the customer stays. We look at how the resident stability of the customer has been. We look at a lot of other nuanced data. Now, for a underwriter, human underwriter, to map all this nuanced data into a very cogent thought process and deal with each and every customer individually in a different way is sometimes difficult. So what we do is that we generally, either whether it's a rule-based process driven or it's a human driven. For example, larger files, big files are mostly human driven. Like mortgage files, are mostly human driven. Machine does some part of it,
Sure.
but the fact is the final underwriting, it tend to follow the middle path. Artificial intelligence or machine learning is a derived form of AI, right? In the sense that they allow you to look at patterns at an individual customer level and underwrite that customer as a n equal to 1.
Sure.
So the underwriting is far more nuanced. What it does is, but what it also is that liberates the sort of the entire underwriting process from some of this what I call middle of the road mediocrity, right? And helps you to take more for a customer. A human eye might miss a particular data point, but when a machine looks at it, a machine runs through a CIBIL score or a CIBIL report or a CIBIL customer CIR or a CMR,
Sure.
or when it scans through the bank account, or when it looks at all other allied data, right? It might identify patterns which might tell that this customer is good, or this customer, though on face of it is looking good, but might have these unseen risks.
Okay.
So that makes the entire process far more stronger. However, it's also very important to note that the algorithms should be properly calibrated from time to time.
Yeah.
Model risk is a very newly emerging area of financial services, where a model might suddenly have biases, or the model, if they're self-learning models, they might suddenly pick up biases and they might do things which are not acceptable.
Yeah.
It's very important as part of your risk team also to have model risk teams that goes and calibrates these models very often, right? And that's when you have a well-functioning system. It's actually very powerful and very liberating. And in L&T Finance per se, we've been actually one of the pioneers in sort of building AI-based underwriting engine. It's an engine which we call Cyclops,
Sure.
right? We operationalized in the month of June. The name Cyclops comes from the fact that it's a one-eyed mythical giant, nothing misses it, right? And the fact is that, for example, for our two-wheeler business, we use 16 algorithms right now.
Wow.
Actually, 18. It's gone up by 2 more. It's 18 algorithms, which humanly is not possible.
Not possible,
So these
yeah.
technologies are very liberating technologies from an underwriting perspective. It makes the underwriting science much more stronger.
Yeah.
But on the other hand, managing these models and addressing the model risk is also equally important.
Yeah. I find it fascinating because a bulk of India has a very limited formal financial history.
That's right.
Right? Because
That's right.
you have a very big segment that's new to credit. Gen Z, for example, or even prior to that. That in an era where you've got real-time credit monitoring tools, predictive analysis, and now you can track a whole wider number of sources than was ever possible before.
That's right.
So how are these innovations changing things?
See, these are changing very fast, and some things which were not possible. See, two things you have to see. Two macro trends, right? One macro trend is that the government is digitizing very fast, right? Many of the government processes and systems are becoming digitized. For example, land records, right? in many states have become fully digitized, right? The housing registration deeds, right, in many states have become fully digitized, right? Similarly, customers also have got digitized to a large extent. In fact, I was in a I know I'm just coming back from the east of India, right, when I was in rural Bengal, and I went for a microfinance sort of collection, and the fact is that almost 75% of it was a group. It was a group meeting, but the ladies were praying digitally in the group meeting using UPI.
Wow.
Right, and the fact is that there are a couple of ladies who really didn't know how to do it, so they called in their husbands to help them, but they were paying digitally, right? So basically, what is happening is that the customers' sort of movement towards digitization, right, especially in arenas of daily sort of living, right, is becoming very pronounced. We are doing a podcast. The fact is that there are hundreds of rural influencers these days. I was in rural Jodhpur, right, and I met an influencer who has 1.2 million followers.
My God.
Right, sitting in a village 130 kilometers from Jodhpur.
Yeah.
So the fact is that one part of the country or the macro trend is becoming digitized, and it is uniformly urban and rural. The other part is that the government parts is getting digitized. When these two are meeting, right, it is becoming very easy for lenders to leverage on that data. And I'll give you an example.
Sure.
I was sitting with a tractor customer in rural Gujarat, right, and I said that आपका बैंक पासबुक दिखाओ. तो बैंक पासबुक निकाला तो देखा कि he is making UPI payments, the milk he's collecting and depositing, that payment is coming digitally, etc., and all this thing. So what for example, RBI Innovation Hub has done is that they have digitized this milk pouring data. Right. So now, I can actually, and each of these customers have an ID. You can go with these IDs to that particular system, pull out how much milk he has generated, how much money he has generated out of that milk pouring. And the fact is that there sits a credit model. You can figure out how much is income from there. That is a supplanting income. But when I'm underwriting a tractor, for example, right now, using one of the providers, I go pull up the land record. So I know exactly that the guy, what land record he's saying, that land genuinely belongs to him. Then what I do is that I pull the last 10 years crop data for that piece of land, which is also digitized thanks to remote sensing. So I know the crop failure rates on that particular plot of land. So I know that what crop he has grown, what has been the crop failure rate, and when this put into an algorithm gives a beautiful predictor of income.
Sure.
Right? So this is how I think, the modern technology or the convergence of digitization of government and convergence of digitization of consumers are powering lenders to take the same decisions, supported by, the data repositories, the customer behavior repositories like CIBIL, helping us to make those underwriting decisions with a greater degree of confidence than probably we could have done 3 or 4 years back.
Bhavesh, thoughts on whatever Sudipta said so far, because these changes seem to be very fundamental and they've been happening over the last, I would say, 5-10 years, and then suddenly you feel they're getting faster and faster and faster. How do you see this from the other side of the table as someone who's monitoring credit profiles, credit scores, and getting information from lenders like Sudipta?
So I would say when we look at from the lens of a credit bureau, credit has really penetrated to the last mile, I would say, especially on the retail side, that you have almost 67 crore individuals data reported to CIBIL ever, which means 67 crore individuals have been given access to credit, which is a huge advancement to what we were 10 years back. That's one. Second is in terms of what it is ensuring is that the credit decision is happening objectively. You have credit bureau data, you have application information, you have, if it's a secured loan, then the asset information, what Sudipta spoke about. So you have a triangulation of all data sources, real time, and happening through a business rule engine, which enables that the credit manager is comfortable to process a large chunk of data through technology, and at the same time ensures that the consumer knows that if I have a good credit history, if I'm living within the means, I can get access to credit in an individual capacity or for my business needs wherever I am in India. It's no more an urban phenomena. It's no more linked to certain forms of employment. So credit has been truly democratized on the basis of technology and availability of data. If I were to say last decade or so, information asymmetry has been solved to a large extent in India.
Yeah. I want to now go into blockchain because this is another exciting technology. We spoke about artificial intelligence, we spoke about machine learning. Blockchain is being explored to enhance transparency and security in the credit process.
Yeah.
So, how do you think, Sudipta, that it could build trust among both consumers and lenders, both sides of the equation?
See, again, blockchain is like, again, if you look at blockchain per se, blockchain obviously forms the underpinning of obviously Bitcoin, and that's the core technology that holds this the crypto coin or the cryptocurrencies together. But the fact is that if you look at blockchain as a fundamental technology, can be very, very, very useful for asset verification, right? And one of the issues that many lenders who deal with, for example, used car, for example, right? You go to a particular dealer and a dealer has got a couple of used cars. You want to start funding, the used cars at the particular dealer. How do you know that that particular used car is not a stolen vehicle, right? You don't know, right? Or that has got some issues, etc., and all that stuff. Now, for example, if there was a blockchain sort of solutioning which when developed, which wherein, every time a car changes hands, right? All the information about that car changing hands gets written onto that entire blockchain or entire token. If every car has a token attached to it, right, and it gets updated, and then it is, for example, when I sell my car to you, right, I verify that I have sold my car to you. You verify on the token that yes, I have bought. The register verifies that yes, this car had got sold, and the dealer who says, or the lender who has previously lent, saying that yes, this car has got sold, this person has paid off. So all the information about that vehicle gets written onto that token, right, and then gets verified by the parties in the system, and then it's part of the blockchain. So the next time when someone goes to buy that vehicle, he has all the information available on the token, and he has all the transaction chain also available to him. Same thing for real estate, for example.
Home loans,
for example. Right? So the verification of the process, who was the owner, who had sold at what point in time, how are the land records, etc. All this being digitized and put on a tokenized system on a blockchain can be hugely liberating. It will build a huge amount of trust in doing third-party transactions, right? And that will, because right now what happens is that people, when they buy, especially when they buy resale properties or when they buy resale vehicles, etc., these are the two areas I think it will be most useful, right? To a certain extent for stocks, etc., is useful, but the fact is that because of the digitization and dematerialization of the stocks system, that has got a large amount of trust built into it. So these two areas, where asset verification areas for especially second sale, is something where blockchain can be hugely liberating for the industry. As of now, probably that has not seen the light of the day, yes, because the fact is that given the the disparate sort of systems in which some of these assets lie, but I do believe that the wherewithal, for example, to take some of the data out of the Vahan database and sort of build a blockchain in it, that has legs to run. Probably that's for a government to build, or for the entrepreneur in partnership with the government to build.
So going forward from a lender's perspective, right, how can the population be brought to the epicenter of credit through technology? I mean, this is going to build out in the next few years. How do you think the process is going to happen?
See, the process has already started. I'll tell you, the process. If you look at, obviously the reason the India stack has been built, and reason, people are, talking about Oaken, for example, right? Again, the Oaken is in the step wherein you bring the borrowers to the lending ecosystem through a structured technology framework, right? Each and every customer, but that requires, the parts of the various layers, the identity layer, the payments layer, everything has got built right now. In India, all those stacks are built. What is and the fact is that the account aggregator layer also got built very well, and is functioning as well. So all the elements, whether it's the identity element, the liabilities, or the cash flow element, or the cash flow analysis element, the bureau element, or the credit behavior element, the payments element, everything is got built. What this needs to get tied into one uniform whole, and each and every customer, for example, if at any point in time every customer knew that how much am I worth in terms of my credit, what I call my credit persona, for example, if I say right now I'm eligible for a loan of 2 crore home loan. Right now I'm eligible for a 12 lakh personal loan. Right now, not every customer knows that. Right? So I think the ultimate step would be where every customer becomes aware of their credit persona, saying that, and as their credit behavior, or as their behavior, as they discharge their loans much, much better, and as the system becomes much, much more stronger in terms of customer awareness, each and every customer will see their eligibilities and their persona improve, right? Which also brings me to one last point, which is probably not spoken that much, it is also the responsibility of the lenders to make sure that the system does not get indebted beyond a point.
Sure.
Now the fact is that all this lending data, or all this data which makes lending easier, also brings with it the danger of over leveraging the customer. Recklessness in terms of a little bit of lending. So it is also important for the lenders also to know when to stop, right? And that is where, probably it is also incumbent on the customer to give the customer some guidance as to probably you're approaching your limit. You should not borrow much, otherwise you'll get into trouble, right? For example, in many advanced countries, for example, in Canada, for example, in the credit card statements, they have a particular which they call the years to pay off simulator. That means if you pay off your minimum amount due, how many months will it take you to pay off this particular loan? That is mandated as part of regulation, right? Which I think is a very responsible lending practice. And some of those stuff probably we would introduce in India.
Very interesting. I'm going to go into two specific products before I go back to Bhavesh. Sudipta. One is small ticket loans. Okay? At one point of time, they were quite very tricky product. Okay. At one point of time, but technology has helped lower the cost of delivering these loans, making them therefore more viable and scalable. Right. How do you see this impacting the overall lending ecosystem?
See, my answer will be an answer that touches both sides, right? Small ticket loans at times is very, very useful because, they are available in tap. They are probably light touch underwriting and very fast process of dispersal. So that is where the benefit is. However, over the years, barring the larger regulated, or what I call the more disciplined players, a lot of edgy practices also crept into small ticket loans, where small ticket loans were dished out. And typically, small ticket loans are taken by people who are suddenly in dire need of money, right? And more often than not, they're people with broken credit, or they're people with no formal credit, or people with no credit history, etc., who fall there are certain sort of edgy lenders, I would call, who also dish out these loans. And frankly, you have to understand that small ticket loans, traditionally, the default rates have been high. So because it does not make sense for you to collect 200 rupees or 300 rupees, you literally write it off because it will cost you more to collect that 200 to 300 rupees. So what happens is people try to rationalize, saying that, so my loss rates on this portfolio will be 10%. So the interest rate that I'll charge on this portfolio is 36%, or, on a personal loan, now, or 30% plus on a personal loan. That is a bit of a regressive trend. And, some of the customers who really do not understand what they are getting into fall prey to this sort of these edgy lending practices. So in a way, on one side, the technology has enabled the fast delivery of this loan, or what we call the sachet loans, right? But the fact is that it is also very important for the industry to regulate, and that is why the digital lending guidelines that RBI has got out, etc., has regulated this to a very, very large extent. And the declarations that you put has regulated this to a very large extent. So I would say the environment has become far more stabler and cleaner. And it's a great customer enabler where customers can pull credit at their fingertips.
Yeah. And the second is MSMEs. Again, pretty large area.
Very large area.
I was reading somewhere, and actually we know it for a fact also, that MSMEs are pretty much the driving force behind the economy, whether you talk it in terms of the number of people they hire or the value of their output. How, from a lender's perspective, what is the current credit landscape for MSMEs?
See, from a lender's perspective for MSMEs, underwriting MSMEs is a far more complex exercise than underwriting normal retail customers, because while you are underwriting an MSME, you are doing multiple underwriting. You are underwriting the proprietors, or if it's a sole proprietor, the only proprietor. You are underwriting the business, and you are underwriting the environment that the business operates in. So there are three things that you are underwriting. And more often than not, many lenders fall short of doing all these three equally well. They'll probably underwrite the proprietor well, because that's almost like retail underwriting. They will underwrite the business as a next step. They'll just not underwrite the environment well. Typically, in many organizations, underwriting the environment is not a part of the decision-making process, while actually it should be 30 to 40% of the decision-making process, because you are lending to an X person who is engaged in a business in a Y industry, but that Y industry is getting into trouble. Are you cognizant of the fact that the Y industry is getting into trouble? Most lenders will not do that. So it's a three-pronged underwriting approach. Of late, that discipline is, I would say, slowly starting to build, where you are now taking an industry view as well, right? And then in your underwriting stack, you're a person, or you're starting to have specialists who will underwrite that. And it's very important for the underwriter also. And see, technology in SME underwriting can be used, right? For example, GST, is a huge enabler. The GST, the data flow in the GST network, coupled with the liabilities data, is a treasure trove, because it tells you how many invoices are pending, what is the business momentum of the customer. GST API access is still probably not as seamless as we would like it to be, but it is getting there. So it's become a very, very useful input to the digitized underwriting of MSMEs, coupled with the CIBIL CMR reports that we get, which gives us rank ordering from 1 to 10 as to, what that customer has been in terms of credit rating and how his previous borrowing facilities have gone. But it is, I would say, MSME underwriting, as much as it is a science, is a little bit of an art as well. It is about taking those calls, which at times your templated analysis is telling you probably the customer wants 1 crore. Your templated analysis is telling you that this customer probably is eligible for 80 lakhs. Do you take the risk on the additional 20 lakhs or not? Now that is a bit of a gut of the underwriter, and the business analysis of the business environment that the underwriter gets. More often than not, people are on the side of the caution. But good underwriters actually take the call, right? Whether to give or not. So as I said, it's becoming more data-driven, more digitized, but it is still an evolving science. Have all lenders mastered it? No, not all lenders have mastered it, but we'll get there.
Bhavesh, so you mentioned CMR. Okay, now that we know that stands for CIBIL MSME rank. That reflects the business credit worthiness. Can you highlight how this rank, the CMR, the CIBIL MSME rank, enables borrowing for MSMEs?
So let me just go a bit into the commercial credit report. It has information of the business entity having taken credit exposure across different credit institutions. One. Second is CMR or the CIBIL MSME rank ranges from 1 to 10. 1 is considered as the best, and it actually is built or delivered basis the credit performance, utilization of the credit facilities, balance build up. All those parameters go into giving a borrower, a commercial borrower, a CIBIL MSME rank. Now, most of the banks have actually moved to linking their rate of interest to the CMR.
Okay.
So you'll see a lot of large banks actually encouraging MSME borrowers, saying that if you have a CMR 1 to 3, we will give you the best rate of interest. In technical terms, it's actually risk-based pricing, that you are incentivizing the borrowers with a good repayment history to come to your institution and take loan from you.
Sure.
So CMR actually enables a business entity to get the best terms and conditions with different financial institutions based upon their business needs.
Very interesting. So an MSME owner has a clear picture of his business credit profile with the CMR. So can you share a personal anecdote of what you see in the business profile, right? When MSME owners come to you seeking financing, what do you see in their profile enabled thanks to the CMR?
See, we look at the obviously CMR again. What we have done is is that basis each and every ranking of the CMR has got a what we call PD or a probability of default, right? And this, so what we look at is that we look at our historical data and look at that at what CMR, what was the portfolio performance, and then we rank order the CMR according to the PD, right? And the CMR anyway rank orders the PD as well. It's a substitution of this CIBIL Bureau score for the individual lenders. But we obviously CMR is. But I'll be very, very candid here that CMR is a necessary sort of condition, but it is not the only condition. We look at a lot of things, and if you were to ask about a personal anecdote, I'll give you an anecdote. At one point in time, I was looking at a file like the customer had. It was a new business. The customer did not have a well-formed CMR score, right? Because it was somewhere middling CMR score. Our underwriters had denied that case.
Okay.
And that file, because I will say that I told our underwriters that I want to look at the files that you guys are denying.
Interesting.
Right? Because of important.
Yeah.
Right? So they used to send 10, 15 files they used to deny every day to my table. Right? And late in the evening, I used to go through all those files. So I was looking through one of those files and I looked at the background of the proprietor. The guy is a MS from one of the renowned universities in US,
Wow.
right? He's building very high-end furnaces,
Okay.
right? And he has got orders from UAE, he has got orders from Abu Dhabi, he has got orders from Thailand, right? To supply those specialized furnaces to some of those businesses, some of those customers, right? And he needs money to build these furnaces, right? As I said, this, and then I went to his website, looked through his website, looked at the quality of furnaces, went through to the people who have given him the orders, right? And then I realized this is a fantastic case. We should lend to this person, right? And that is one of the problems. I called my underwriters and said that, look, the fact is that you are not underwriting a customer holistically. When you underwrite a customer, when the customer gives you a file, the customer gives you a lot of data. You guys only look at the financial data.
Yeah.
You do not look at the allied data that comes along with it. And so this case which you guys have declined, this guy you should lend because you look at his order book, you look at his profile. He's not a guy who's going to default and run away. Right? He needs this is the money for growth capital. If you give him, he will pay back. And these are the customers also whom he has orders from are good customers. Right? So I don't see a risk, right? Yes, there might be a small risk, but that is financial services is all about risk. It is about taking that calculated risk, right?
Yeah.
So that is where, I do, and as I said, I go back to my sign. Have organizations in India really mastered the art of SME underwriting? No, they don't have. Most of them straitjacket into a couple of ratios and they do not holistically underwrite the customer. The moment we start holistically underwriting the customer, probably a lot more of credit tap will open to MSMEs in the country.
Very interesting. And it's exciting to see how the innovations are shaping the future of credit, especially in markets that have long been underserved. Thank you so much, gentlemen, for joining us on this very interesting conversation. And to our listeners, thank you so much for tuning in onto this episode. Stay tuned as we bring you more credit conversations with CIBIL.
Thank you.
Thank you. Thank you, Anupam.